When it comes to selling your business, most owners focus on one thing, price. But in M&A, structure matters just as much, sometimes more. How a deal is structured affects your payout, your involvement post-close, your taxes, and whether or not you get to participate in the next chapter of growth. In this video, we'll break down the common deal structures in the lower middle market so you can enter the process with clarity and exit on your terms. In the first section, why structure matters. In the lower middle market, companies with 2 to 20 million in EBITDA, buyers range from private equity firms, family offices, and strategic acquirers. Each type of buyer brings different preferences around structure. Understanding the mechanics behind these terms can help you make smarter decisions and avoid surprises down the line. Let's walk through the 7 most common deal structures you'll see. The first one is a majority recapitalization, or a recap. In this deal, the buyer acquires a controlling stake, usually 60 to 90%, while you retain 10% to 40% of the equity. This structure lets you take some money off the table now, but still participate in the future upside when the business is sold again, called a second bite of the apple. It's very common with private equity firms and often includes preferred return rights and other investor protections. Next is a full buyout. The buyer acquires 100% of the business and you fully exit, often after a short transition period. This is a great fit if you're retiring, exiting the industry, or if succession planning is unclear. Strategic acquirers and some private equity firms use this structure when they want full control. It often includes clawbacks, escrow, or post-close adjustments, so the payout isn't always as final as it sounds, but it does provide full liquidity. An earnout is when part of the purchase price is contingent on the future performance, typically over 1 to 3 years. Buyers use this structure to bridge valuation gaps or motivate sellers to stay involved. Earnouts are usually tied to revenue, EBITDA, or customer retention. But here's the catch, they're not guaranteed. If targets aren't met, you might not receive that portion of the payout, so they require careful negotiation and can create friction post-close if not handled well. The next form is seller financing. In seller financing, you loan a portion of the purchase price back to the buyer in the form of a promissory note. This structure helps buyers reduce upfront capital needs and shows good faith on your part. Terms usually range from 3 to 5 years, with interest rates between 6 and 10%. These notes can be secured or unsecured and often subordinated to senior debt. It's higher risk, but can also offer yield if managed properly. Next is an equity rollover. This structure is often paired with a recap. You take a portion of your sale proceeds and roll them into a new entity, typically as preferred or common equity. It aligns your interests with the buyers and gives you skin in the game for the next growth chapter. Rollovers can range from 10 to 40% of the deal and are common in PE-backed deals where a second exit is likely. Next is a management buyout. In an MBO, your existing management team buys the business, usually with outside capital. This is a great option if you're seeking continuity and trust your internal team to carry the business forward. Private equity firms often support MBOs by providing the financing. These deals depend heavily on the capability and readiness of your team. You may stay in as an advisory role, but ownership and operations transfer internally. Lastly, we have a strategic acquisition. In this deal, a strategic buyer, like a competitor or a partner, purchases the company with plans to integrate it into their operations. They may offer a premium price based on synergies, like cost savings or cross-selling opportunities. But integration risk is real. These deals often include earnouts and holdbacks to hedge that risk. If culture and operations don't align, post-close can be bumpy. Key considerations. When evaluating a deal structure, keep these in mind. Deal clarity. Earnouts and seller notes come with risk. Post-close involvement. Do you want to exit cleanly or stay involved? Tax impact. Stock versus asset sales can change your net proceeds significantly. Cultural risk. It's critical if you're rolling equity or staying on. And second bite potential. Rollover equity and recaps can double your exit over time. The best structure, it depends on your goals. In closing, there's no one-size-fits-all deal. Every owner has a different story, timeline, and vision for what comes next. At DealGen, we help founders not only get to the table, but walk away from it feeling like they made the right deal with the right structure. If you're thinking about selling or just trying to understand your options, let's talk. We'll help you navigate your path with clarity and control.